Ladies and gentlemen of the crypto space, we're live on a Friday, May 31st at 11:48 a.m., mostly on time today. Seeking Credit is the title, and as you are all well aware, I think often about the very high level structure of the system, and that is all knock-on effects and pressures and regulations are surely a pressure. They affect behavior. They change the way people and corporations behave, especially with regard to money and especially with regard to credit. Credit is everything. Credit is what fuels growth. Credit is what allows expansion, the taking of risk, entrepreneurship, and it's the foundation of small business. Net 30, net 90. Small businesses do not pay up front. They acquire inventory, sell the inventory for profit, then pay the bill once they actually have the capital from the selling of their inventory. And terms are usually 30, 60, 90 days. I've even seen 120. Point being, what facilitates that is credit. So, why is this important post 2020? And it's the rising interest rate environment, and it's everything the Fed says with regard to higher for longer. And even when they cut, interest rates will remain elevated. This plays into the refinancing of government debt. There is a huge amount of it, and it is not just the United States, it is globally. And now all this debt requires a creditor. It requires balance sheet capacity, as Mike Howe talks about. So the creditor needs to have balance sheet capacity to facilitate the refinancing of all this government debt. Now, obviously, there's granularity, there's subtleties, there's nuances in the composition of debt. Obviously, there's corporate debt and shit and private debt. But the point is, at the highest level, a huge amount of it, if not the vast majority of it, is government debt at this point. Which means a huge amount of balance sheet capacity is required at elevated interest rates, and regulations are going to be encouraged, if not enforced, that change the capacity of creditors to, or not the capacity, but encourage them, either incentivize them or force them to issue credit to very specific debtors. So, for instance, it's a hot topic currently, domestic United States, for bank regulations to adjust the way they can compose their balance sheet, what assets contribute to their capital requirements and what do not. So, if regulations skew commercial banks to only invest in U.S. government debt and significantly discourage private credit or private lending, that is certainly going to curtail consumer price inflation. It's also going to curtail GDP. It's going to impede, restrain credit cards were freely given away for as long as I can remember as an adult. The odds are this world that we grew up in, this world I grew up in, is changing. Credit will not be as easy to obtain. Now, obviously, I'm thinking from like a 5, 10, 15, 20-year time frame. And I'm thinking of normalcy that we experienced for the last 10 years, 20 years. The vast majority of my real adult life, my 30s, was 10 years. And that was the 2020s. And that world is going bye-bye. It's changing, and it's literally screaming that just on the chart of 10-year yields. Higher lows, higher highs, higher for longer, higher interest rate environment. It's not necessarily going to be the case that refinancing is necessarily harder. I think debtors will find creditors, but I think what we'll see on average is creditors are going to really like to lend to governments, because governments, especially the United States, can print the currency that they owe on that debt. So the face value of that debt will always get paid. And regulations might just force them to do just that. Um, so what does this mean with regard to the crypto space? Because I think crypto is the most exciting market of markets on the planet. So fortunately, credit is not permissioned in these crypto markets. Credit is permissionless. You have a capacity to use collateral and extract equity from it in the form of dollar liabilities. Now, those dollar liabilities are managed from an infrastructure perspective using interest rates, depending on supply and demand, and that force behavior, specifically repayment, and obviously enforce liquidation if collateral volatility makes the position non-sound. Even though it's a debt position, it's sort of a carry trade, or at least it's a component of a likely carry trade. And if that trade is no longer viable because the collateral pricing no longer substantiates it, the creditor will deterministically liquidate your ass. And that's why these credit markets are so profound compared to traditional financial institutions. So what does that all mean? I just ended on crypto credit, and we were talking about the recomposition, the changing world of traditional finance and credit thereof. Uh, that is an interesting future from an investment perspective for these crypto markets. Credit is sought in consideration of regulatory arbitrage, jurisdiction arbitrage, geographic arbitrage. So what is the crypto space geographically? It's accessible to all nations, but is a market of no nation. Regulatory arbitrage, it's regulated by countries, but geographically it's not of any country, and there's no money transmission. There's no FX. You need the capital bridges, but that's a matter of entrepreneurship, and that will be fought with regard to regulations. Uh, but as we know from a financial perspective, if money wants to do something, it kind of can. So if you're pick a European country, and the next closest European country is 100 miles away, and you need to get capital to a jurisdiction that has a friendly regulatory environment to get capital into crypto markets, to seek credit, and you have to do it because no bank is lending because they're balance sheet constrained, then you do it. Because often credit is a matter of business function. Credit is required for business to actually function. So credit is clearly the word credit, but credit implies, in good part, existentiality. Business cannot get access to credit. The odds are that business does not work. So what does existentiality say about geographic arbitrage, regulatory arbitrage? Oh, shit. So to me, when I see the changing world of interest rates, balance sheets being constrained or at least required to be composed differently, and regulations for commercial banking to become the recycler of U.S. debt, whereas Saudi Arabia was that for a long time with the petrodollar system, and China and Japan sure as hell recycled a lot of U.S. debt. They can't do it because they have their own respective domestic financial complexities. I mean, they're literally talking about it, about domestic U.S. commercial banks basically becoming the recycler of U.S. debt. And that's sure as hell interesting from a crypto market capacity to offer credit. A world where traditional financial credit is changing and crypto is coming online, accessible to all nations of no nation, offering credit permissionlessly. That is not a word that exists in traditional finance. You cannot walk into a bank with collateral of any form. Can you walk bearer bonds? The hell has bearer bonds nowadays? Can't walk into a bank with $1 million in gold bars and walk out in 30 seconds with credit liabilities, dollar liabilities, which is also called cash, which is also called actually paper dollars for that matter. So you can in crypto markets. That's weird. So what is interesting collateral? It's likely changing. And what is a market where that interesting collateral can be collateralized to acquire dollar liabilities is pretty interesting. And that's these crypto markets. So every time you hear me over the last years talk about whatever particular protocol that I'm interested in, this is the framework in which I'm thinking of these systems. They're not protocols, they're businesses. And these chains aren't chains, they're markets. So this is a market of businesses accessible to the planet of no country. I don't give a shit what narrative is going on social media, what the hot topic is of fear and uncertainty and doubt. This is the place for capital. There is no other businesses on the damn planet that are more interesting than purely financial businesses, part of the financial economy, in a world where the real economies are fucked. Where the real economies they're being suppressed. Suppressed to manage political optics. Why? Because consumer price inflation affects political optics, or political optics must be cognizant of and respond to consumer price inflation. That's a very popular public talking point. So, unfortunately, in this world, there's plenty of countries around the world where this has played out, and it's the bifurcation of classes. In many emerging markets, you're either poor or quite wealthy. And very few countries around the world have a decent middle class. Or, yeah, there's plenty of middle class, but you know what my point being is the composition of the United States is clearly changing. Middle class is less and less, and wealthy and poor are more and more. And just contributes to the observation that the whole system is changing. Now, when I say changing, it doesn't occur in 5 minutes, 5 days, 5 weeks, 5 months. It's imperative to understand the time frames in which I talk about are usually a decade or two. And 5 years we could clearly talk about from a cycle perspective. And what cycle would that be? Sovereign debt refinancing cycle, which contributes to the global currency expansion cycle and is coincidentally associated with the Bitcoin halving cycle, but that's just coincidence now, is it? That's not the cycle, though. Cycle is it's really the global currency expansion cycle that means everything. So that's a lagging indicator for price action. The leading indicator is the need for sovereign debt refinancing, which sets the stage for the global currency expansion. So as sovereign debt gets recycled or refinanced, the composition of debt in circulation changes and volatility ends up getting suppressed. I mean, literally, that's just mood indicator right there. So when you see this is the leading indicator of leading indicators for where the hell we are in crypto price action, if that's what you're into nowadays. You young kids, you. This rolls over. This allows debt to be refinanced, and as volatility is low, that debt is used as collateral to contribute to the global currency expansion. That's the mechanics. And I've told this story in countless different forms over the years, but I guess that's a decent, simple way to explain it, why this is a leading indicator. This is the leading indicator of leading indicators. And you could understand that, as I've explained at times, in crypto credit processes that you may engage with. If Ethereum is going from 3,000 to 4,000 to 2,500 to 3,500 in a matter of days, the odds are most people aren't going to be borrowing against it. they don't know what is going on. They are uncertain. And when uncertainty exists, credit is suppressed. And that is the antithesis when volatility is low. If Ethereum is $3,500 for 6 months straight, and you're sitting on $3,500 worth of collateral, you're going to be borrowing money against it. Clearly, this applies to Bitcoin as well. So that's the way volatility affects the currency creation process, the global money supply expansion process. It's all about volatility. Volatility affects emotions of the investors, and investors either are active or patient. Volatility high, they're patient. Volatility low, they are active and pursuing opportunity. Be it a carry trade, which technically everything is a freaking carry trade. You borrow money to build a business. That business better produce more money than the interest on the debt used to create the business. It's all a goddamn carry trade at the end of the day. So that's where we are. Move indicator back up to 91. 28 days left in the 3-month candle. What we want to see is a rejection of the time-weighted average price. We're in comfortable territory for the time being, meaningfully below the time-weighted average price at about 103, give or take. If we go to the monthly, because we just close on the monthly today, it's not a bearish engulfing. It is support on the 200 SMA. What are SMAs on a volatility indicator? So what this indicates is a push through the 200 SMA, and it was a failed breakdown. So it's a support position. What do we say about support? Support is a position of weakness, and I don't know. You can't take too much away from a volatility indicator and technical analysis from a candle perspective and a moving average perspective. But I think the 3-month is broadly constructive. Trend is down for the last 2 years, and what goes down keeps going down until you have capitulation. We clearly see producer price inflation rolling over, and just all these distortions in the employment sector. Just the jobs market is supported by immigration. So there's all these distortions all over the place. So the data that everyone's looking at, I think it's just so distorted at this point that the only way to make sense and engage with these markets in a constructive fashion is to just peer through the bullshit. Go sovereign debt recycling, refinancing, capital expansion cycle as a result of all that refinancing. Watch for the move indicator to roll over, and then boom, we're off to the races for at least a period of time where an epic, monumental amount of debt is flooding the Eurodollar market, and dollars are being printed everywhere, and we have the cycle that everyone has become accustomed to, rather periodically at this point. But that's where we are. We haven't started the cycle yet. We haven't even started yet. Move has not broken down meaningfully yet. And it will, because that's the directionality. Directionality doesn't just stop and reverse. It continues until some sort of capitulation event. Anywho, I hope that helps, guys. Hasn't even started yet. Sir Joe, President, accounted for tap. See what's up, y'all. Irreverent Nexus. Hello. Gasik, hey, Cap, gonna watch this one later. Cheers. Have a nice weekend. Thank you very much. You as well. Leandro, good morning. Akin, what's the composition of collateral in crypto debt markets look like going forward? Composition of collateral. Well, clearly, it's all volatile. So what are interesting talking points with regard to crypto, credit, and debt? I think the collateral makes sense to use Ethereum and Bitcoin, but look at stuff like Abracadabra. Look at what Aave has done historically with V2 and particularly LP. LP positions as collateral? That's fascinating. CDO squared type stuff. So that's the most interesting thing about these crypto markets. I don't give a crap about the collateral. What I care about from a business inspection standpoint as an investor, what businesses are going to offer the best credit products to people that want to consume them? So in traditional finance, you have this insane accounting practice called HTM, hold to maturity, where basically the face value is assumed because the government's going to pay the face value upon maturity. That has unintended consequences, as we've seen with certain bank failures that are forced to liquidate HTM positions because they need the capital. Now, in crypto markets, particular protocols, and clearly Darwin's going to play out, and we've seen some very interesting things. Look how well Abracadabra has recovered. Look how well KeyDAO has recovered, PEG. And these are based on, threshold liquidations, much like liquidity. I am quite fond, as you are all well aware, of the llama and CRVUSD, particularly its soft liquidation engine and its real-time interest rate adjustments. That's the core of the protocol, and Frax does this as well. If there is a requirement for repayment to manage PEG, to make sure the liabilities are worth $1, interest rates need to go up, and they need to keep going up until repayment is forced. And that is fascinating because that doesn't happen in meat space. You're not going to go from a 5% interest rate because the opportunity and the composition of debt to liabilities says, lend money, let's make money, let's get credit out there, to 80% interest rates in a week because all of a sudden the composition requires repayment of debt. There too much credit has been extended, and they need to make sure the integrity of the balance sheet, which is basically the PEG, is there. So the PEG is really, in crypto markets, floating. It's FX PEG, which is fascinating how interest rates can be used to manage a PEG in an FX market. It's organically. And it's organic because it's deterministic. It's just the nature of the software. Jack the interest rates if you're under pegged, if you're at 0.995 and you want to get to 0.998, jack the interest rates. People are going to buy the currency and increase the price of the currency because they don't want to pay 60, 70, 80% interest on their debt. That's how you create buy pressure on a currency. You don't have to worry about sell pressure on a currency that could be printed by a protocol. So if you're above peg at 1.05 or whatever, you could literally just print the currency into the FX market. And it's all done deterministically, automatically, by software that doesn't have a brain, doesn't have an opinion. And frankly, CRVUSD is immutable, which makes it brilliant. Hope that helps. Anyway, that's clearly a digression from what you were talking about, Ken, but I think it was interesting points. Currently, Ethereum leads as collateral use, but that's obviously in these EVM markets. Everything is such testnet to this day. Well, let's talk about these markets when there's $5 trillion liabilities, USDC, USDT, MIM, CRVUSD, MAI, pick a stablecoin, the 10,000 derivatives of MakerDAO, and another 10,000 money markets, forks of Aave, another 10,000 copies of CRVUSD, and $5 trillion in these markets. Then we'll really get a sense of what the hell is going on. This is all testnet. What has occurred in the last 4 years is pure Darwin. Natural selection. What has survived? What has done well? It has shown us foundational infrastructure for what will be the base reference going forward, the base technology to iterate upon. So Aave, V4, Frax's BAM Tech and Fraxtal, it's all just starting. You got to get a sense of 5 years. That's the perspective to have. Think 5 years into the future and look back, and what we have, It's all just testnet, baby. It hasn't even started yet. John, are you still in Ren? If so, any updates on the project? I am in Ren because I bought it so cheap back in 2019, that no matter how bearish it got in 22, it was still in the green. So let them do what they're going to do. The complexity that's obviously the case is the amount of size of a portfolio. And for me, that position size, I might as well just sit on it because the tech they have is software. So they have tech. They have technology that no one else has. So that to me is interesting, and I'll let them figure out what the hell's going on, and I think they will because there's tech there. And whether they do it or someone buys it, I don't think that tech is going to evaporate into nothing. And that's generally my sentiment. Does it take 5 years or 10 years? I don't give a shit. But that may mean something with regard to your time preference as an investor. For my time preference for this particular asset, I have no time preference. I actually just don't want to liquidate it because it requires clicks and vesting, and I don't need to. So that is something to consider when I state my opinions on this topic. Hope that helps. I think there is much more lucrative investments. I think there's a tremendous amount of opportunity cost with it, particularly because it has an unknown timeline. I can afford an unknown timeline. So obviously this market is going to start moving at some point in this year, and then next year it's just going to go full banana zone, Raoul, and therefore an unknown timeline in this kind of climate has a fair amount of opportunity cost. Fun fact. Hope that helps. Tape pusher, LP as collateral is crazy. Yeah, once everything is tokenized, BlackRock has mentioned, it will all be used as collateral, which means even more credit expansion. Listen, I got no problem with credit. I got no problem if someone wants to borrow capital, have at it. If you can't pay back, I'm taking your money. The collateral is going to get sold. Frankly, that is also a unique construction of these crypto markets. It's all over collateralized, which is not necessarily seamless with what people are accustomed to in traditional finance. Everything in traditional finance is built around under collateralization, if not no collateralization, like a damn credit card. So it's zero collateral loan. And in crypto markets, it's all over collateralized debt, so which favors persons that have money. So that's very consistent with money makes money. And that is not the way the world is heading. Heading very social, but that's another story. So money certainly makes money. That has and will continue to be the case. If you have assets, as Tape Push is talking about, you're going to be able to borrow money against your assets to acquire more money. And that's what everyone talks about when they look at Fed data and Fred data, where the vast majority of assets are held by wealthy persons. And if you don't have assets, you're not really getting anywhere at all. So we're clearly heading down into a conversation about disparity. So that should be your expectation. Disparity is going to continue to get worse. The directionality is clear, and trends continue until capitulation. And capitulation with regard to disparity is not something we're prepared to talk about yet. Check back in 10, 15 years, 20 years. But that's not going to be a fun destination. A purely bifurcated class system. Hello, India, because that's pretty much what they got. Hope that helps. DeFi Advisor is in the house. Good morning, my friend. Throw your comments if you're on X or YouTube. More than happy to talk about anything on your mind. Do not hesitate. Akin. One day I'll say your name right, but I hope I do. So dynamic interest rates become the core regulatory mechanism to keep markets in order in real time. Yeah, there is nothing like it in traditional finance. So in looking as an investor in traditional finance, what are you investing in? When you invest in a bank, you're not investing in banking. You're investing in a fucking stock, which is a capital raise mechanism for a company. You're getting no cash flow from their business operations. You're getting nothing for the mortgages that they're lending, you're getting leftovers. So I talk about this on social media. Dividends from equities are the leftovers after OPEX, operational expenses, bonuses, executive pay, and then the dividends are talked about in the board like this. Let's give these fucking peasants a couple of more pennies so they could shut the fuck up and keep giving us money so we could keep raising capital and do shit. Peasants. That's what a dividend is when you're talking about 0.5%, 1%. No, give me 50% of your goddamn company's income, and then I'll consider investing in your business. And that's the core foundation of my investment methodology is basically, fuck you, pay me. You want me to invest in your company, how much are you paying weekly? 0%, but the growth of the stock price? Fuck you, pay me. So clearly REITs come to mind. They're required by law to return the vast majority of their capital to shareholders, but even REITs have a board. Even REITs have a capacity to dilute their shareholders by selling shares to raise capital, to engage in business activity. So the complexity with traditional finance is the subjectivity of humans in the business. The beauty of crypto finance, there's no people, there's no real estate, there's no board, there's no OPEX, there's no debt on the balance sheet. I mean, listen, if Warren Buffett was in his 30s and 40s, even Charlie, I don't give a shit. They called it rat poison because they weren't prepared to digest a company that has zero debt, zero OPEX, zero human resources, that executed like a robot, like a machine, deterministically, inputs and outputs. These are the best value investments I have ever seen in my entire life, which are probably going to play out in growth terms as well. We're talking about pure cash flow businesses that return almost all of the capital that they earn as income to their investors with deterministic share issuance, which is often disinflationary. Yes, I'm talking about monetary policy, which is, from an equity standpoint, akin to share issuance, but in this instance, it's deterministic. It's not subjective. Disinflationary. It's going to get less and less and less and less and less. So in 10, 15, 20 years, what do you think the disinflation is going to lead to? Oh my goodness. Determinism and immutability change everything. And when you apply them to purely financial businesses, you're talking about what's got to be the best investment I could possibly think of. Software. That's a business that you can inspect from a value investment standpoint. Holy shit, people are sleeping. Everyone's sleeping. I don't need anyone to tell it to me. I will get on my soapbox and scream it. Everyone is sleeping on the analysis that I just laid out for you. These are dividend offering companies, and no corporation could offer a dividend comparable to this because they have OPEX and human resources and people to pay and executive salaries to pay. Hope that helps. DCA Man. Good morning, Captain. Can you explain to us how Japan is the convex of USA? Well, historically. Right now, they're not able. They're constrained with regard to their current currency and situation and bond market insanity. So, historically, we financed our fiscal deficit by exporting our debt, and we raised that capital we raised from the debt we used to buy shit from overseas, and that exported dollars, and other countries had a surplus, so they had extra capital which they put into a piggy bank. They saved it. So you could save in many forms, and it just so happens a very desired form of savings for the last decades was U.S. government debt. And that's a process that can be referred to as recycling or sterilization. So excess supply is put into savings accounts that are held for a long period of time. to maturity, would be optimal. But as Grumman talks about, these savings accounts are filled to the brim of U.S. government debt around the world. They needed to spend it to buy things to accommodate U.S. dollar-denominated inflation and FX market volatility. So Japan has had to sell debt, China has had to sell debt, Russia complexities, Saudi Arabia is looking to diversify. That was the origin of the recycling and sterilization concept. We would buy their oil, they would save and store their money in U.S. government debt, their excess money. And, the petrodollar is still there, and you need these instruments clearly from a product standpoint as collateral, because you're going to get paid face value because the dollar, U.S. government is going to pay dollars face value even if they have to print it. So it's still pristine collateral relative to other nations. It's still the most sought after currency, and it's at historic highs with regard to use for international settlement. The U.S. dollar. Go figure. Check back in 20 years, then we can talk. So that is how and why Japan amassed $1 trillion worth of U.S. government duration. Treasuries basically. China had a lot too because they had just a massive surplus for so long. And still, I think they're running a historic surplus right now. So what do you do with savings? And right now, China has restructured around gold. Why do you think the gold prices are up so high? Well, that buy pressure from China. So the argument that folks are moving away from U.S. government debt as the savings account is probably true. It is true. There are changes at the margins occurring, but these processes operate on celestial time frames. Supernovas, shit that takes 1 million years to play out in space. Check back in 10 years, 20 years, and we'll see the composition of the global financial system restructure. I'm not going to play it out any differently next year, probably next cycle, most likely next cycle, heading into the 2030s. And we'll check back 2035 and we'll see how the composition of things has changed. So that's how Japan is the convex of the USA, my friend. Good stuff, good stuff. And rent-sinking proclivities of humans. Well, listen, that goes back to just human nature to want to rent and to want to lend credit. That's why socialism never worked, because humans are greedy and one person wants more than someone else. So if you take that away, you destroy incentives, you destroy motivation. And that has historically what plays out with socialism. It's against human nature. And then if you fight human nature, it doesn't create a stable system. Anyways, it's not a political conversation. That's frankly a quantitative type of statement. If you tell someone you can't have any more, you can only work 8 hours, you can't work overtime, you are limited in your salary, at some point that person's going to be like, all right, it's 5 o'clock, I'm getting the fuck out of here, I'm not doing any work. And at some point, their work performance before 5 o'clock is like, all right, this is stupid, I'm not getting anywhere in life, who gives a shit? Maybe I'll leave at 4:30 if no one notices. So productivity gets destroyed. Productivity only occurs because a human is incentivized to be as productive as possible. And they are incentivized not just by compensation, they're incentivized by future potentials. They're incentivized because they see a future that they're excited about, that they're working towards it, that they're building towards something. And the second that's constrained, productivity gets destroyed. And I can say this from personal experience. Very personal experience with my entire professional career. Even at jobs, the fuck gives a shit about a 3 to 5% raise? Oh, I'm going to work really hard this year for a 5% raise. Oh, yeah, you got me there. Anywho, I am DC. Hello, my friend. Hey, Cap. There is me getting... Oh, let me find it. There's me getting frustrated when my APR in crypto go from 80 to 50. Perspective indeed. 50% is life-changing. I posted it earlier. Let's find it. It was a good one. Look at this shit. 80% to 50%. The numbers that we deal with in the crypto markets are insane. A 40% CAGR, compound average growth rate, turns $100,000 at 20 years old into 3.5 million, into $4 million at 30. 40%. And at 30, you could take out $600,000. So $100,000 invested at 20 at a 40% CAGR, you could take a $600,000 salary at 30. And then at 40% CAGR, next year you could take a $672,000 salary. The year after, a $752,000 salary. The year after, an $842,000. You're 33 years old and you could take an $842,000 salary. And that's with $100,000 invested at 20 at a 40% CAGR. So you're talking 80% to 50% IMDC at 40%. At 50%? Holy shit. At 80%? Ho, ho, ho. So the youngsters running around with the meme coins don't get what these returns, these rates of returns are. Bitcoin's CAGR is 88% over 10 years. Ho, ho, that's why so many people are so damn wealthy. That's insane. 88%? Holy shit, these numbers. These numbers get absolutely crazy. And that's with the drawdowns. That's with the 95% drawdowns in the early days. 88% on average. What the hell do you think is going to play out with crypto financials? Where you have regulatory arbitrage and geographic arbitrage drives trillions of dollars into these credit markets. It could be very interesting over the next cycle. My mind's already at 2027, 2028. I'm already thinking about 2031. Those are the years that are interesting. And I'm 41. If you're 20, that you should not even be thinking about this cycle. You need to be preparing for 2027, 2031. That's where you should be thinking. That's where your opportunity is, and that's where your time frame needs to be because of this chart right here. Here, I'll even put this in the chat for you guys so you could stare at those numbers and be like, holy shit. And that's just simple math right there. Anywho, crypto solves what's wrong with stocks, but they don't see the value in immutability. It's a scam. Crypto still has an identity crisis. Okay, that's great for me because they're immutable. That means they will exist and continue to exist, and they cannot be made to not exist. Obviously, barring electricity not existing, and I don't know. But the point is, under normal circumstances, in the most reasonable circumstances, these pieces of software that are financial businesses are immutable, and they will continue to exist in perpetuity. So they can have all the identity crisis they want. That's just more of a mispricing, which is more of a time that people can invest relatively cheaply. And that's what we talk about, discounts versus premiums, which are perspective of the cycle. Very important from a cycle perspective. So if you buy Bitcoin at 60 grand back in 2021 and you're at 67 grand right now, didn't buy it at a discount. You bought it at a damn premium. So that's why we have in our entire methodology we talk about, especially in private Discord. Shameless plug for our Discord, the most rational community in the crypto space, where we talk about these things, as well as accounting for that matter nowadays. So it's important to buy at a discount, simply from a consumer perspective. Don't buy shit that's expensive. Stop buying shit that's expensive. Buy shit that's cheap. If it's expensive, you can't buy it. You can wait for it to be cheap. You may never get it cheap, but that's the point. If you don't get it cheap and it's expensive, you can't buy it. You missed it. And that's okay, because there will be a period in time where everyone's shitting their frickin' pants and it'll be at least cyclically cheap. If you can't get a discount, at least get a cyclical discount where you buy in where everyone thinks the world is over. And you don't bet that when the world is over. So you buy the assets when everyone thinks the world is over because the world keeps going on. Hope that helps. Hey, Cap, what would invalidate the kingdom narrative for you? Well, something better. And right about now, they're pretty dominant, especially what I'm seeing play out on Linnea, how they've taken dominant position. Further confluence is Arbitrage, where they've basically topped Grail, Camelot. So that is substantiating their strength going forward. Frankly, they've made it to the top of the list on the chains that they are deployed on. So how do you invalidate? Obviously, malfunction invalidates things. Disruption, but they are the disruptor. They are actually disrupting the other businesses. So invalidation requires data that says it's failing. Price action doesn't mean much because the rates of return are doing exactly what I look for. So if I'm making 120% APR on basis, the cost of the position on Nile and 70% APR on Ramses relative to my price point of entry, I don't really care much about the cost of the principal, the position cost. I care about the cash flow on a weekly basis. Now, bear in mind that it's complicated because right now, compared to entry, RAM is like 4 or 5x. That means significantly different calculations. But this plays into what I talk about with regard to XYZ. How much does it cost? How much is it paying? And how likely is it to continue to pay into the future? It's the most important calculation you could possibly have with regard to my core investment thesis in 3 lines. How much are you going to pay me? And it's your responsibility to execute risk management to assess, they're probably going to keep paying into the future. And if it's too risky and you think it's not going to continue paying, probably not a good investment. And this helps you consolidate and concentrate your portfolio into the things you think are most meaningful. You have to have a concentrated portfolio. You cannot have excess diversification. Cannot spray and pray. And I know a lot of people do that because they don't understand what they're investing in. They're like, you need to understand exactly what you're investing in. You need to have a rigorous methodology. You need to have defined rules, operating procedures. Makes all the difference, ladies and gentlemen. Tape pusher, big thumbs. Pretty much wraps it up for today. It's a good topic. Friday, y'all get to relax over the weekend. I as well. Not going to go through Twitter with you guys on stream, but it's a never-ending stream of interesting shit what's going on. So, hey, look at this. Look at it. Boom. Interesting. They're going to throw additional incentives on top of vote rentals on the warden. Gotta love it. Gotta love it. All right. I wish you all a good one. Tell everyone to subscribe. You know we have our private Discord, ladies and gentlemen, which has started to build up in popularity yet again. It looks like it's that time in the market again where people actually want to be more rational, do a little bit better, make educated decisions, define rules, talk about accounting, so on and so forth. And that's what we've been doing in private Discord. So it's a good place, especially a place where people have survived the entirety of the bear market. So there's a lot of veterans, a lot of experience in a private Discord nowadays. Friday, May 31st at 12:37 p.m. I wish you all a good one, and I will see you again after the weekend on a Monday. Peace.